The markets are closed, screens are dark, the last price is frozen. It's a holiday weekend. But behind closed doors nobody is celebrating. Something has broken. Inside Manhattan boardrooms and Federal Reserve conference rooms, emergency lights are on, phones are ringing, lawyers are present. This is not routine. This is damage control. Silver didn't just rise. It jumped 10% in a single session. In commodity markets, that is not volatility. That is a structural failure. When a core monetary metal moves this fast, it doesn't create profits. It creates insolvency. It snaps models, shatters leverage, and exposes hidden fragility. Banks don't trade silver with cash. They trade with leverage, 20 to 1, sometimes 50 to 1. That leverage works until price moves violently. At 20 to 1 leverage, a 5% move erases all equity. Silver moved 10%. Do the math. Entire balance sheets just vanished. This is why meetings are happening right now. Because some positions cannot survive the Sunday night open. Someone is already underwater. Normally, margin calls solve the problem. Pay up or liquidate. But what happens when the client is too large to liquidate? What if the short position belongs to a major bank, a sovereign entity, or an industrial giant hedging billions in exposure? You don't liquidate them. You don't send the invoice. You call regulators. You call the Federal Reserve. You call the exchange. You say one sentence: if the market opens normally, we default. That sentence shuts down weekends. This is not unprecedented. Bear Stearns, long-term capital management, the Hunt brothers, same pattern, same weekend, same panic. When leverage collapses, price discovery becomes dangerous. The system doesn't fear high prices. It fears uncontrolled prices. At the center of this storm is the clearinghouse, the invisible backbone of the market, the guarantor of every trade. If a bank fails, the clearinghouse pays. If multiple banks fail, the clearinghouse bleeds. If it empties, everything stops. Silver shorts today are measured in billions of notional value. The default fund is not designed for gaps this large. If silver opens higher again, losses could exceed the insurance pool. That is the nightmare scenario being discussed. Because once traders doubt the clearinghouse, liquidity evaporates, trust disappears, markets freeze instantly. To prevent that, exchanges have emergency powers: margin hikes, position limits, trading halts, liquidation-only orders. Lawyers are reading rulebooks right now, searching for clauses that allow them to slow the market legally. They've done it before. Nickel trading was canceled, GameStop buying was halted, precedent exists. Never assume silver is protected. When systems are threatened, fairness is optional. Survival is mandatory. But intervention has consequences. You can control paper. You cannot control physical demand. If New York suppresses price, Shanghai doesn't care. Dubai doesn't care. The metal flows east. Arbitrage drains Western vaults. Artificial caps create real shortages. Every intervention accelerates depletion. That's the paradox. The harder they suppress price, the faster physical silver disappears. Meanwhile, collateral is failing elsewhere. Bonds are unstable. Inflation is rising. Political debt ceilings loom. Collateral values are falling while liabilities explode. Banks are squeezed from both directions simultaneously. To raise cash, they must sell other assets: stocks, crypto, anything liquid. This is how a silver squeeze becomes a macro event. Liquidity is vacuumed from everything else. The meeting isn't about silver profits. It's about preventing a system-wide liquidity seizure. But here's the flaw: they can pause futures. They cannot pause industrial demand. Manufacturers don't buy silver for speculation. They buy it to keep factories running. Solar panels, missiles, data centers, EVs. No silver means no production. Those buyers don't care about margin hikes. They pay cash. They secure supply. In fact, higher volatility makes them buy more. Fear creates hoarding. Every rule change pushes real buyers further from paper markets. This is why meetings feel desperate. Because tools exist, but every tool worsens the long-term outcome. Now add psychology. Expect Sunday headlines: regulators monitoring volatility, markets functioning normally. These headlines are not information. They are psychological operations. The goal is simple: scare weak hands into selling, create liquidity for trapped shorts. But this time is different. The public doesn't trust reassurance anymore. They see prices, they see shortages, they see gold breaking records. Confidence is the currency of the system, and confidence is evaporating. When confidence fails, meetings don't fix it, only price does. This is not a bull market anymore. This is forced repricing. Leverage that once suppressed silver is now launching it upward. The system built a trap for itself, and now it's inside. The question isn't whether silver moves higher. The question is how violently. Sunday night liquidity will be thin. Fear keeps sellers away. When nobody wants to sell, price jumps without resistance. A single market order can teleport price levels. If silver opens far above last close, it signals loss of control. This weekend isn't preparation for strength, it's preparation for impact. Now the focus shifts to the emergency tools. The first weapon is always the margin hike. It looks technical, but its purpose is psychological. Raise margins and leveraged players panic. Cash is demanded immediately. Positions must shrink or die. Last time margins rose 50%, it failed. Price kept climbing. That tells you how deep the pressure really is. So the next step is extreme. 100% margin, no borrowing, cash only. That move crushes speculators instantly. Funds built on leverage are forced to sell, regardless of conviction. But it doesn't stop the real buyers. Industrial giants don't use margin, they use balance sheets. For them, higher margins are helpful. Weak hands disappear. Supply loosens briefly. Opportunity appears. This is the mistake regulators always make. They fight yesterday's traders, not today's buyers. The second tool is position limits. Artificial ceilings on ownership, justified as risk management. The exchange can order forced reductions, sell contracts, or face penalties. But capital doesn't disappear. It migrates: OTC desks, London forwards, Shanghai contracts. You cannot fence a global commodity with domestic rules. Position limits slow price discovery in one venue, while accelerating it elsewhere. The third option is the nuclear one: liquidation-only trading, no new buys allowed. This guarantees price suppression on paper. Demand is banned, selling is mandatory. It also permanently destroys trust. Markets never recover reputations lost this way. If silver buying is shut down in New York, liquidity moves permanently to Asia. This isn't speculation, it already happened. Nickel proved it. Capital remembers betrayal. That's why this option is discussed but rarely executed. It's financial suicide. So regulators are trapped. Every tool they use creates long-term damage. They want a slow rise, manage descent, no gaps, no headlines. But markets don't respect intentions. They respect supply and fear. Now shift focus to the physical market. This is where control truly ends. Coin dealers are watching these meetings closely. They know paper hedges may fail. That's why premiums remain elevated. Inventory is protected, not liquidated. Some dealers may close entirely. Better no price than the wrong price. Spot becomes symbolic, physical becomes reality. A widening gap appears: paper silver at 80, physical silver at 100. That spread is not greed, it's counterparty risk priced honestly. Meanwhile, miners have noticed the shift in power. For years, miners sold metal into suppressed prices set by paper traders. Now the paper market is begging for supply. Some miners are withholding shipments, stockpiling production at the source. Why sell today when tomorrow promises desperation? Miners are acting like central banks, managing reserves, timing releases. This creates an air pocket in supply. Nothing reaches the exchange. Banks assumed fresh mine output would relieve pressure. It isn't coming. Now consider geopolitics. Silver is not mined in New York. Mexico controls roughly a quarter of global production. At triple-digit prices, governments take notice. Windfall taxes, export restriction, strategic stockpiles. Any of these actions would instantly double price pressure. Banks cannot hedge political sovereignty. This is the ultimate unmanageable risk, physical assets in foreign hands. Now enter the shadow banking sector. Highly leveraged commodity funds operating outside strict regulation. Rumors are circulating. A large fund is reportedly insolvent. Short silver, long bonds, both trades collapsing simultaneously. If liquidation begins, it triggers forced buying without price sensitivity. This is how markets go vertical, not optimism, mechanics. Liquidation ignores resistance. It buys until exposure is gone. Holiday liquidity makes this worse. Few sellers, massive urgency. Every forced buy lifts the floor higher. At this point, silver is no longer trading. It is escaping. While bankers panic, corporate procurement teams are awake. Technology giants are not watching charts. They are securing supply at any price. Samsung, Microsoft, defense contractors. They don't buy silver monthly. They buy years forward. Private contracts are being negotiated quietly. Entire future mine output locked away from public markets. Every off-market deal shrinks visible supply. The float evaporates without headlines. This is privatized hoarding. Silver disappears before it ever reaches an exchange. Banks are trapped trading paper in a pool that is being secretly drained. Now the retail public wakes up. Search traffic explodes. Social media fills with silver charts. But retail faces a problem. Physical is scarce. Dealers are empty. Delivery delays stretch for months. So money flows where it can. Mining stocks. Brokerage apps become the gateway. One-click exposure, unlimited liquidity. Mining equities become pressure valves for unmet physical demand. Small miners turn into momentum vehicles. Liquidity floods in. Developers become takeover targets overnight. Major miners need reserves. High prices demand expansion. Mergers accelerate. Premiums explode. 40% gains happen in hours. This is the equity phase of the squeeze. Now return to the charts. Silver has entered blue sky territory. No historical resistance exists. Algorithms switch to mathematical navigation. Fibonacci extensions become roadmaps. From the breakout, the first major magnet sits near $85. Above that, the golden ratio points toward 96. Psychology completes the move, $100. Round numbers change behavior, unit bias shifts. Ounces become grams, accessibility expands. Millions of small buyers replace a few large sellers. This democratizes the squeeze. It becomes unstoppable. Higher prices do not destroy demand. They accelerate hoarding. Corporate buyers front-load inventory. Fear overrides cost optimization. Demand spikes into rising prices. Textbooks fail. Now consider the Fed's dilemma. To save banks, liquidity must be injected. Liquidity weakens currency. Weak currency strengthens silver. Every rescue reinforces the trade they fear. This is a crack-up loop. Now the Monday open approaches. Liquidity will be thin, sellers hesitant, buyers urgent. A gap higher signals loss of control. A forced dip signals intervention, not resolution. Both outcomes favor physical holders. Now the action plan. First rule, do not sell into panic. Liquidation events do not guarantee pullbacks. Second rule, audit counterparties immediately. Paper claims may settle in cash when delivery matters most. If you don't hold it, you may not own it. If exchanges halt, ignore screens. Street prices decide reality. Frozen markets validate the thesis. Reprice wealth in ounces, not dollars. Ignore propaganda. Scarcity is not speculation. This weekend marked the shift. The paper age blinked. The physical age asserted control. Monday doesn't start a trade. It confirms a new system.